Have you ever wondered? The Fed keeps talking about cutting interest rates. So why are mortgage rates still so high? Why do stock markets suddenly panic out of nowhere? And why does the economy never seem to truly ease up? Most people look for the answer in the United States, but the answer is actually hidden thousands of miles away in Japan. Back in the 1990s, Japan experienced a massive economic collapse. Real estate crashed. The stock market crashed, and the economy spent years going nowhere. In response, the Bank of Japan lowered interest rates to nearly zero, then kept them there for years. This forced Japanese investors to do something interesting, because they could no longer earn meaningful returns at home. So they started investing overseas, especially in the United States. Think about it. You borrow money in Japan at almost zero interest. Then you take that money to the United States and invest it in bonds, yielding 4 or 5%. Easy money. For years, trillions of dollars flowed out of Japan and spread across global markets, into U.S. Treasury bonds, technology stocks, real estate. In short, global markets spent decades feeding on Japan's cheap money. But in 2024, things started to change. Japan raised interest rates for the first time, then raised them again, and suddenly investors realized something. Borrowing money in Japan isn't as cheap as it used to be. That's where the problem began, because the money that had been flowing into the United States for decades slowly started moving back to Japan, and that means less demand for U.S. Treasury bonds. When demand for bonds falls, yields rise. And that's the key point most people are missing. The Fed can control short-term interest rates, but long-term rates are determined by the market. So even if the Fed cuts rates, mortgage rates can remain high if demand for Treasury bonds weakens. Buying a home becomes harder. Corporate borrowing costs increase. Even stock markets can come under pressure, because at the foundation of the modern financial system lies the bond market. And for the last 30 years, one of the hidden pillars supporting that system was Japan. Now that support is slowly being pulled away. Maybe there won't be a major crisis tomorrow. Maybe nothing dramatic happens at all. But the biggest question isn't AI, inflation, or politics. The real question is this: is the world finally reaching the end of the cheap money era it has enjoyed for the last 30 years? Because if it is, the consequences won't affect only Japan. They'll affect all of us.